Apple reported its earnings yesterday and is down now nearly 4% in the pre-market. We're going to take a look. Is this a company we want to be buying now? A very high quality one. What happened in the earnings? We're going to find out. We're going to, as usual, take a look at their income statement, their top line revenue growth and bottom line net income growth year on year based on those latest earnings. We'll have a quick look at the health of the company, total cash versus total debt. We'll see how well they've been performing versus some of their competitors over the last 5 years. We'll discuss a lot of insider selling that has happened, nearly 25 million over the last few months, and we'll look towards the institutions to see whether or not they have been buying or selling more quarter on quarter. We'll look at the dividend safety. We'll run through some important financial metrics to see how the company is shaping up over the next few years, and we'll discuss their earnings to see whether or not this 4% was warranted or is a strong opportunity for us investors to buy more. And as usual, we will run them through the valuation model, getting to the intrinsic value and the acceptable buy price given our investor margin of safety, and take a look at Wall Street and see what they are forecasting for Apple over the next 12 months. So let's jump straight into the headlines now for their earnings. We can see that Apple stock does fall after the company gives an outlook suggesting weak iPhone sales. So a few key points. They did report their first quarter earnings yesterday. It beat estimates for both the revenue and EPS, which we will touch upon now. But unfortunately, and what the market didn't like, was that 13% decline in sales of China. So let's take a look at some of these numbers to really understand. Now, a 13% decline in sales in China is huge, given it is a very important market for Apple. And we can see that yesterday, after hours, it in fact dropped more than 4%. So when we take a look at exactly how they did numerically, well, earnings per share, 218, so they beat analyst estimates by 8 cents. And we see on the top line, they did come up nearly 2 billion higher than expectation. So very positive to note. In terms of their income streams, well, what we can see, iPhone revenue, they beat. We can see there nearly 2 billion, in fact, higher than expectations. In terms of Mac revenue, they beat 7.78 versus 7.73. iPad, they actually came down under, so they did less than what analysts expected. Other product segments, very strong. Services revenue, unfortunately, slightly lower than expectations. But in more positive news, their gross margin, we can see looking stronger. It did increase from 45.3 expected to 45.9. Right now, we don't have any future or forward guidance for the next quarter. So let's take a look and understand how this company has been performing. Now, over the last year, it is up 28%. We do see, whilst it hasn't updated as we're in the pre-market, it will now be trading in the midpoint of the 52-week range. A yield of around 0.51% and a forward P, which we do expect to come down to around 27 once the market opens. Over the last 10 years, phenomenal performance, 907%. Granted, it doesn't include those dividends reinvested. Nonetheless, a strong performer in anyone's portfolio. In terms of the numbers, as always, 3 to 7% is a base that we like to see. Tech companies will be higher. For Apple, 260 billion reported in 2019, 383 in 2023. Very strong growth when we look at it over the last 5 years. It has increased very, very strongly. In fact, nearly 50%, which is positive to see. On a more granular level, it does increase all the way to 22. It is worth noting, though, the top line did decrease from 22 to 23. In terms of the bottom line, the story that can be told there, 55 billion in 2019, 97 billion in their latest annual report. So we do see nearly double growth, in fact, to their bottom line, with the top line showing 50% increase. But similar to the top line, we see an increase to 22 before a drop into 23. Overall, looking very strong. Their top line is increasing over the last 5 years as well as the bottom line, but it is important to understand some small inconsistencies. Total cash and short-term investments, 100 billion in 2019, phenomenal. Latest quarterly report, it has dropped to around 73 billion, nonetheless extremely high. And when we take a look at their total debt, what we can see is it has pretty much not moved from 108 billion in 2019 to 108 billion in their latest report. And we'll look at some of their debt metrics shortly. So very quickly then, looking at companies in the technology, hardware, storage and peripherals, we have Dell Technologies, Super Microcomputer, HP and a few others. Well, look, over the last year, Apple has been fairly mediocre in terms of the competitors, up 29%. Now, that is a pretty strong return, total return, in fact, so including those dividends reinvested. But the industry as a whole, Dell, SMCI, have performed very, very well. Over the last 5 years, we see Apple the second best performing, up 368%. Very positive. This wouldn't be a bad return on anyone's investments. SMCI, though, does take the cake, 3,723. Nonetheless, do remember that past performance is never an indicator for the future. Now, very quickly, we run through our screener here, the insider buys and sells of over the last 3 months. Now, insider selling, whilst I do like to pull this out, it isn't necessarily considered bearish for the reasons that insiders sell for many reasons, personal, financial. We actually see Chris sell twice, who is the principal accounting officer, but the most important one here is the secretary, the senior vice president, Catherine Adams, who sold 23 million worth of shares. Now, we do know that the price has dropped slightly from then, but again, I wouldn't necessarily call this a bearish signal. If we see insider buying, however, that is a very strong bullish signal as insiders buy because they believe the share price will go up. Institutional ownership sits at 58%, as we can see here. 71 billion worth of sales over the last 12 months, more than double buying by these institutions over the same period. So it shouldn't really come as a surprise. Institutions are buying a lot more of Apple than they are selling. Q4, the latest quarter, a lot more that we can see, 18 billion versus 3, although we know in Q3 we did see the opposite. Always, though, do your own due diligence, never copy institutions. Dividend safety score, 99, very safe, 2.9 trillion market cap. It is a mega cap company. In terms of those key recessionary metrics, well, they hadn't paid a dividend in the last recession. Very strong, above average growth, plus 14% versus the S&P's average negative 12%. But they had a near enough recession return, negative 50% versus the S&P's negative 55%. Dividend growth, viewers will know that I find this pretty mediocre, 4.3%. It is just keeping up in line with inflation whilst the yield is very low. And over the last 5 years and 10 years, we have seen some okay increases. I would like to see this come up to double digits. They do have a lot of cash, and if they aren't doing share buybacks, at least return some cash to shareholders through this dividend increase. In terms of the essential number of years, they have been increasing those dividends for the last 11 years. Let's take a look at dividend yield theory. Now, new viewers, it basically states a company is undervalued when the current yield sits above the 5-year average. 0.51 versus 0.64, this is a sign of overvaluation. Bear in mind, though, we don't look at any of these models in isolation. We'll draw conclusions towards the end. Forward PE 28.3 versus the 5-year average of 26.1, another sign of overvaluation. And we note the sector PE for information technology does sit lower. In terms of the free cash flow payout, which is what we always draw your attention to as the earnings is susceptible to manipulation by management through accounting, below 60% for the majority of companies, very nice to see. Not only is it incredibly low, but it has also been decreasing, although you could argue this given the mediocre increases to their dividend. It would be nice to see a double-digit increase, 2024 looking at 14%, so it shouldn't be a surprise if we do see a nice jump. Free cash flow per share pretty much tripled over the last 10 years. Yes, it isn't consistent. It does move in the right way. 2024 expected to go even higher at $7.07. So there are no real worries with this company so far. The only thing that we can say, the sales growth, it does look very haphazard. We see some years double-digit growth to the top line, then single-digit, and then negative. It does seem to form some kind of pattern. Now, it will be interesting when they do release their forward guidance to see their expectations. But overall, very, very inconsistent. Nonetheless, though, it has been growing more than 2 times their top line over the last 10 years. One thing we love to see, which Apple do very nicely, is returning excess cash to shareholders through their share buybacks. They have heavily reduced this from $24.5 billion to $15.8 billion in 2023. In terms of the ROIC, as always, you want 10% or more. It gives you faith management are able to effectively allocate their capital. Nice to see for Apple, well above that, as well as it's increasing 61% in 2023. Very, very, very well. Margins, phenomenal in the mid-30s over the more recent period, above the minimums, and the free cash flow margin pretty consistently in the mid-20s. So that is nice to see. Strong metrics and consistency. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, remember, shows us the balance sheet strength as well as dividend safety. This essentially shows us in 2023 it would take them 0.44 years to pay off all of their debt net of cash on hand. 2024 expected to go even lower. No worries with this company, balance sheet wise or dividend safety wise. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. First formula, Graham's valuation. Given how strong Apple's top line is, you could argue that this one is irrelevant, but again, some people may prefer to include this. For this episode, we will not be including this. If we jump into the first model, the multiples valuation model, we have the average P of their competitors multiplied by the earnings per share of Apple to give an intrinsic value of $272. So we have a huge sign here of undervaluation with an intrinsic value of $272. We then move on to the dividend discount model. Now, the average growth rate at 5.64, I am quite optimistic that we will now start to see some very nice increases to their dividend. So the intrinsic value based on this model, as we can see, in fact comes considerably lower. So we have a sign of overvaluation. We then move on to the third and final model where we have those free cash flows year on year. And we can see the average growth at 12.21%. Forward looking at 10%, a little bit lower than analyst estimations and the average growth rate to be more conservative. With a discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We can see another sign of undervaluation. So today's episode of Apple, the intrinsic value is the average of these three models and it comes to $212. As always, do click on that pinned comment below if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. So we start off with a margin of safety of 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. If you believe that for Apple, well then right now $191 up to that price would be a buy. If we go up to 15%, we can see at $180 it would be a buy on a 15% margin of safety. For those that are looking at 20%, you would be looking at $170. For me personally, I do hold Apple in ETFs, and in the ETFs, Apple does make up a significant portion. So for me to be looking to add this, I would be waiting for a 20% margin of safety at around $170 to buy. Now, if I didn't hold Apple through an ETF, in all honesty, at a 15% margin of safety, I would be adding Apple at this price right now. In terms of Wall Street and what they expect over the next 12 months, well, they see 14% upside with a price target of $206. They do believe that Apple is a buy. As always, do let me know your thoughts in the comments below. Have you been adding to your position of Apple here, or are you waiting for a larger drop? And don't forget to smash that like button if you enjoyed today's episode, subscribe, hit the bell, and as always, I'll see you on the next one. Goodbye for now.